Trump's remark that countries can get closer to China if they want has acted as an accelerator for Latin America. Many trade initiatives that had been stalled for years are suddenly moving forward. Brazil, for example, didn't read this as mere permission. It saw it as confirmation of a new reality and quickly elevated its coordination with Beijing to an institutional level. Across the region, governments and businesses are diversifying trade routes amid growing uncertainty over U.S. tariffs. Asian partnerships are no longer just headline news. They're shaping real business decisions, contract terms, insurance rates, financing costs, and eventually consumer prices. This isn't a sudden break, but rather a gradual, strategic shift toward Asia. The phrase, Beijing line, is no longer just a metaphor. It's visible in container routes, signed credit agreements, and port power supply projects. In recent weeks, a more telling sign has emerged. Latin American leaders are now openly discussing joint, multilateral responses rather than country-by-country bargaining. This approach tackles customs, financing, and trade rules all at once, a necessary step for economies hit by tariff shocks, where access to imports, raw materials, and intermediate goods matter as much as exports. China's integrated offers, combining financing, port upgrades, rail links, and energy infrastructure, are especially attractive. They don't just reduce costs, they reduce uncertainty. And in trade, certainty is often more valuable than a short-term discount. The numbers confirm this shift. China-Latin America trade passed $500 billion in 2024, with Brazil accounting for nearly half. The relationship goes far beyond soybeans and iron ore. Strategic minerals like copper and lithium, non-agricultural materials, and even components tied to microchips and electric vehicles are gaining ground. This diversity makes the trade less vulnerable to any single tariff shock. By contrast, U.S. tariffs inject volatility. Rates can change overnight, making importers cautious and exporters struggle to secure financing. Port slots get tighter, shipping plans are delayed, and those costs eventually filter down to consumers. Meanwhile, Asia-bound contracts, while longer in distance, bring stability and predictability. Latin America's strength lies in its commodity base. Brazil dominates in soybeans, beef, and iron ore. Chile is crucial in copper. Argentina and Bolivia hold lithium reserves. Peru contributes mining resources. Mexico adds manufacturing and medical equipment. Colombia brings coal and energy. This diversity reduces dependence on a single customer or market. And when Beijing's offers also include technology transfer, financing, and access to markets, Latin American industries find it easier to plug into the system. On the ground, the transformation is visible in infrastructure, modernized ports, expanded railways, LNG storage, smart power grids, and streamlined digital customs systems. Chinese financing doesn't just fund cranes and docks, it supports electricity grids, backup power, and logistics integration. This helps close Latin America's infrastructure gap while smoothing supply chain risks. Of course, the U.S. could counter this, but not with slogans. What businesses want is procedural clarity. Clear timelines, targeted exemptions, simpler customs codes, and reduced collateral requirements. If Washington delivered this in writing, companies in Latin America would adjust quickly. But without it, the region keeps deepening ties with Asia and Europe. This isn't without debate. Some Latin American governments insist on strict conditions in areas like environmental standards, local employment, and technology sharing. Done right, through transparent tenders and accountable contracts, this avoids debt trap concerns and strengthens legitimacy. Done poorly, it fuels political opposition. Shipping routes add another layer. The Panama Canal's water levels, transit fees, and port efficiency directly affect Asia-bound trade. That's why Latin America is investing in multiple terminals, rail connections, and Atlantic diversification, essentially an insurance policy against bottlenecks. Energy also plays a central role. Expensive oil, gas, or coal raises fertilizer and food costs. Chinese-backed projects in refineries, LNG terminals, and renewable energy not only secure power but also stabilize agricultural inputs and factory productivity. Looking ahead, the automotive and tech industries will be the next flashpoint. Asian EV and microchip production relies heavily on Latin America's lithium, copper, cobalt, and nickel. If U.S. auto tariffs remain unpredictable, the global auto supply chain could permanently realign along the Asia-Latin America axis. In the end, Latin America is pursuing a multi-channel balance, contracts with Asia for stability, standards with Europe for predictability, negotiations with the U.S. for procedural clarity. This balance reduces budget risks, lowers premiums, and creates more stable employment. So when people say, U.S. influence is waning, it's not just a political slogan, it's visible in trade routes, contracts, and infrastructure. Over the next 6 months, expect permanent expansion of Asia-bound trade corridors, greater reliance on European standards despite higher costs, continued hesitation toward U.S. routes due to tariff volatility, growing need for coordinated infrastructure, energy, and logistics in Latin America, more transparency and fiscal discipline in Chinese-financed projects to ensure legitimacy. To put it simply, containers move faster than politics. Trade flows follow certainty, not rhetoric. 2 key questions remain for businesses and policymakers. Without procedural clarity from the U.S., will Latin America reverse course? And will Beijing's growing backbone in the region become permanent as standards and transparency tighten? Share your thoughts below. If you subscribe and turn on notifications, you'll get timely updates on trade, ports, and consumer pricing shifts as new agreements take shape.